Hey, good afternoon, everybody. This is Lori Thompson with NADO. I'd like to welcome everyone to today's webinar, and thank you all for calling in. Before we get started, I'm going to hand over the controls to Christine Frost from Northern Border Regional Commission. Christine?
Thank you, Lori. Welcome, everybody. I'm sure that you've either heard this through somebody in your office or you attended the Local Development District training that we held at the Tramp Family Lodge in Vermont on the 16th and 17th. We're hoping that this is valuable to everybody and that we continue to be able to do these things over the course of the next few years. So your feedback will be important. And I hope you get a lot out of this. And I'm going to turn it back over to Lori.
Thanks, Christine. I just want to reiterate to everyone, again, thank you to those of you that were able to come to Stowe a couple of weeks ago. I, for one, learned a lot from participating. Just it was a great opportunity for me to learn about what you all are doing across the region, and I was really excited to see the dialogue and conversation and the new friendships that were formed. Which was one of the goals of the workshop, was to help start sort of a professional network of folks from the region. And thanks to everybody who attended that participated in the evaluation. And the feedback has been very positive and very helpful, I think, for Christine and Northern Border Regional Commission as they move forward with training in the future. So if you weren't able to do the evaluation and you'd like to, it's still up and live. And if you need the link to that again, let me know and I'll send it to you. As we mentioned, Bob was unable to join us in Stowe because, as he says, he can't be in two places at one time. So we thought the next best thing would be to have him do a couple of webinars for folks on the topics that we wanted to cover during the workshop but couldn't in his absence. So today's workshop is on the OMB uniform guidance in general, and we'll have some very useful information for folks. And then next week, he's going to dive much deeper into procurement and the changes that came about within the past year or so regarding procurement and federal grantees. I think both webinars will be incredibly useful for everybody. Before I introduce Bob, just a couple of logistics. Hopefully everybody received my email last night that included a copy of the presentation, so you can take notes if you want while we go throughout the next hour or so. And I also sent along 2 CFR 200 just in case you didn't have it and in case Bob references it today and you wanted to take a look at it as he's talking. And finally, we will be recording this webinar, so I will send it out to folks probably early next week so you can have it as a reference, and then I'll also send it to the folks that were at the workshop last week but couldn't be in on the call today. So let me move on and introduce Bob. I think some of you may know him already. He's done work with NADO for 10 years or so now at our conferences and through a series of webinars over the past 4 years. And he's also been a trainer at many of the EDA regional conferences, and beyond that has worked directly with individual LDDs across the nation on many things. Bob is a respected authority on policies and practices affecting the award, administration, and oversight of federal grants, contracts, and sub-grants. He has 40 years of experience in federal award implementation, and prior to launching his management consulting practice back in 1982, he was the executive director of the Grants Management Advisory Service. He's been a consultant, trainer, and advisor to award and audit units in 16 federal award-making departments and agencies, and to recipient and sub-recipient organizations and their professional advisors located in all of the states, U.S. territories, and 18 foreign countries. So I think you'll get a sense of his expertise and knowledge today during this webinar. And just a note, too, that I know Bob is very willing to have folks reach out to him after the webinar if you have specific questions, and his information is included on the last slide in his presentation and in the handout I sent you. So one final thing, if you have any questions for Bob, rather than interrupt during the webinar, if you could just write them into the little box that's on the right-hand side, I think, of your computer screen, please do that, and we will get to those questions towards the end of the webinar. Having said that, I'm going to turn everything over to Bob Lloyd.
Okay, well, thanks very much, Lori, for that introduction and for arranging for me to be part of this webinar series. I I was disappointed when you called initially that I couldn't come up to Stowe. I think this webinar is a pretty good fit because as you know, I worked for 2 councils of governments before I undertook to be a consultant. One of those councils was a local development district in the Appalachian region, so I'm familiar with regional commissions, and I've certainly had considerable time along the northern border. I was at one time a resident of the Lakes region in New Hampshire, and my brother still lives in the area. And I went to college in Maine on the shores or the banks of the Kennebec River. So I guess we've got a couple of folks from that area here as well. But because I make my living now focused on federal grant requirements and helping organizations comply with the terms and conditions that they take on, it's an opportunity to work with some folks that I hope will be successful here. Let's start out with just a little bit of background about this so-called uniform guidance, or what some people have referred to as the super circular, because on slide number 2 of the deck, I identify some of the things that got us to where we are today. First off, as I'm sure many of you are aware, there were multiple grants management requirements that the federal government issued, primarily based upon different kinds of performers. There were a set of rules for state and local governments, another for colleges and universities, a third for nonprofit organizations. And while there was a great deal of similarity in some of those rules, it was always a question of why not treat everybody the same way. That certainly got motivation when the American Recovery and Reinvestment Act was passed in the early part of the Obama administration, the so-called stimulus program. That was the biggest influx of federal assistance funds we've ever had in our history. And because of that, a lot of attention got devoted to requirements that were attached to those funds. It was actually, I think, fairly remarkable that very few problems arose in that program. There was a lot of predictions by some who weren't supportive of it that it was going to lead to all sorts of fraud and abuse, and ultimately that really didn't happen. But some of the reason why it didn't had to do with some policies that have now been brought forward in this uniform guidance. There was strong presidential direction for regulatory reform and burden reduction in the effort to achieve this single comprehensive set of policies, and a long process of rulemaking. In fact, 2 iterations of proposals in the Federal Register where OMB took comments from interested parties. And not surprisingly, some of the parties who weighed in were federal agencies themselves, recipients, and independent auditors. And what OMB had to do as a result of all that was they had to balance a lot of conflicting views about what was involved. Just for one example, one of the things that probably all of you have confronted already is that the threshold for triggering a single audit under the Single Audit Act of 1984 as amended was bumped upward. When OMB originally proposed that, they proposed to raise the threshold to $3 million of federal funds expended during a fiscal year of a recipient. Well, you can imagine how happy the American Institute of Certified Public Accountants was with that prospect, because a lot of clients would go away. And that's just one kind of example of the balancing act that OMB had to achieve with respect to these requirements. Now, if we turn over to slide number 4, what was the result of all this? Well, first off, with the exception of the vernacular of the so-called super circular, or what some people are calling the omni circular when they don't think it's that super, the terminology has changed. The official title of this policy is Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. And it's codified in Title II of the Code of Federal Regulations, Part 200. So this really represents the critical mass of federal requirements that your organization has to follow, regardless of who it gets its money from. Each of the federal agencies was forced to adopt these requirements verbatim, and they did so on December 26th, 2014. Now, in addition to that, each of the federal agencies was given the authority to issue separate federal agency implementing regulations. Now, why were they doing this? Primarily because in some federal agencies, there are statutory requirements that go beyond what the uniform guidance says, and statute takes precedence over regulations in the structure of federal policy. So, certain federal agencies had to issue additional items related to their expenditures or the expenditures by their grantees as a result. Those of you who deal with the U.S. Department of Transportation will probably see the most of this sort of thing, because as you well know, the Congress takes particular interest in highway infrastructure projects and other kinds of things that are funded by the U.S. DOT. So, you know, despite the fact that there are separate supplemental regulations, again, going back to my initial statement, the vast majority of everything you have to follow when you have a federal grant or subgrant is still going to be in 2 CFR 200. Now, as if to prove that this policy wasn't perfect, the Council on Financial Assistance Reform, which was an interagency group put together by OMB to get buy-in by the federal agencies vis-a-vis this policy, that group issued a number of question and answer documents in 2015, 2016, and 2017. And those FAQs, as they're called, are an attempt to further interpret the requirements that are present in the uniform guidance. Well, the critical thing to remember is if the answer to those questions differs from what's in the regulation governs, because the frequently asked questions did not go through federal rulemaking. Now, as if to show a problem that also arose here, when the Trump administration came in, as I'm sure you're well aware, there were a number of things that they wiped out of the way that the Obama administration had done. And one of the things they got rid of was the CFR. The responsibility for oversight of these policies in a government-wide context now rests with something called the Chief Financial Officers Council, which is a statutory group, which obviously the Trump administration can't wipe out of the way. But the problem is that the CFO Council has lots of things on their plate besides grants management. So I don't think that this subject is getting anywhere near the attention that it got when it was being developed. Now, moving over to slide number 4, what's the verdict about what did get done? Well, I think I'd characterize it as 3 steps forward and 1 step back. It wasn't a perfect document. Those of us who work with it on a daily basis can point to places where there are problems, but many of the policies that have been in place for years and have worked were retained. Some things that needed reinforcement were reinforced, most notably in the area of indirect cost recovery. And I know from experience working with some of you that indirect cost recovery has continued to be something of a conundrum because of the way things have been done in these requirements. Some policies that impose burden on recipients and sub-recipients have been dumped. Most notably, some prior approval requirements, getting federal agencies out of the way, letting organizations take action on their own without checking with the feds. Another place where this happened is in the time and effort reporting area. OMB loosened up those requirements and established a more uniform approach across the entire grantee community. Some new policies are causing heartburn. As Laurie indicated, a week from today, we're going to be doing a workshop on procurement, and probably that's the the subject matter that's caused the most angst. So I'll save a little of that for next week. But suffice it to say that, organizations that have had to implement the procurement requirements have had a certain amount of problems. And finally, some mistakes have been made. There are still some features of the requirements which need to be fixed. And I know those have been called to OMB's attention, but when and if they will respond remains to be seen. Now, one of the things you're going to see throughout the rest of the slide deck is a bunch of citations to 2 CFR 200 and to subsections thereof. One of the things I want to make sure of is that you've got a reference to go back to, so that later on when you say, well, I thought I heard Bob say that this was the requirement, that's going to have to rely on your memory, but going back and looking at it in black and white usually will reinforce that memory effectively. Now, my orientation in terms of covering the subject matter is picked up on slide number 5. And I'm going to talk about things from a standpoint of the grant life cycle. What are the things the regulation addresses throughout the pre-award, post-award, and after the award sequence? A second component is to talk about the kinds of management systems you're required to have. Now, this is not completely new under the sun. Organizations aren't starting from a standing stop in terms of their policies and procedures. But I think a wise decision on the part of any organization that gets new federal awards that are subject to this requirement is to hold their existing policies up against the templates that are established related to financial management, procurement, property management, and particularly to sub-recipient management. If you're getting a federal award from above and then turning around and sub-granting it to somebody else, OMB has hung a big light on the responsibilities that you have. And so I know we've got some representatives from state government here. You folks are in a particularly vulnerable position relative to that, because many of the programs you administer are ones that, by design, are given to a state government agency who in turn sub-awards to dozens or scores or even hundreds of other organizations within the state. And finally, focus on the budget structure. This is particularly important from a standpoint of the cost allowability requirements. There are 8 direct cost categories in the Standard Form 424 application for federal assistance. But the cost principles in 2 CFR 200 cover 54 types of costs. So how those things align with one another is certainly a piece of information that must be understood. Now, moving on to slide number 6, let's get into the life cycle of the award and what the regulation has to say about it. And the first event that occurs in a federal grant is solicitation, an announcement to eligible organizations about the availability of funds. One of the things that OMB wanted to do here was to standardize the federal agencies' practices relative to that, and to make sure that federal agencies provided potential recipients with sufficient information that they could make an informed decision about whether to apply for the funds. So the first issue was federal choice of instruments. There's a federal law called the Federal Grant and Cooperative Agreement Act, which creates a legal structure for how the federal government deals with non-federal parties. What that act says in principal part is if the principal purpose of a federal action is to buy, acquire, purchase, or procure something for the federal government's use or benefit, that will be done as a federal contract. The rules for governing federal contracts are contained in the Federal Acquisition Regulation, which is 7 thick books of rules that the federal government tells itself how to buy things. On the other hand, if the principal purpose of the federal action is to assist, stimulate, or support a non-federal party in the conduct of a public program authorized by law, that's going to be handled through a grant or cooperative agreement. And the super circular, or the uniform guidance, is the rules that apply to that arrangement. Now, One of the things that OMB has also introduced into the lexicon in the new rules is the idea of so-called fixed amount awards, which are assistance awards where the amount of money provided is a fixed amount as opposed to a cost-based system. And this is something that's been experimented with in a number of federal agencies, but OMB is encouraging federal agencies not just to dip their toe into this, but perhaps get their foot into it as well. And the notion here is that these types of instruments will be simpler to administer because they don't involve a lot of cost accounting and back-end auditing. The other major part of the discussion of solicitation relates to public notice and funding opportunities. Federal agencies are required to use grants.gov, which is the single U.S. government portal for announcing federal grant opportunities. The acronyms that you see there on slide number 6 are acronyms that the individual federal agencies use. There's no standard practice, for request for applications. NOFA, notification of fund availability. FFO, federal funding opportunity. And PA, program announcement. Well, what OMB has done is to say to the federal agencies, whatever you call it, make sure you're putting the right stuff into it. And so there's a standard solicitation template that's been provided as part of Appendix number 1, Roman numeral 1, of 2 CFR 200. My suggestion to you is that whenever you see a solicitation for a federal grant opportunity, you hold that opportunity announcement up against that template and see whether there's anything missing. And if there is, then follow up with the potential awarding agency to get clarity on what's involved. There's nothing, no harm's going to come to you by doing that. And it may very well be that there's some defect in the solicitation that needs to be fixed for all organizations to be able to make those informed decisions. Now, moving on to slide number 7, let's talk about application. And there's not a lot of difference here between what you've experienced in the past and what's going to go on in the future. In part, that's because of a law that a lot of people don't believe exists called the Paperwork Reduction Act and its regulations. Paperwork Reduction Act manages federal information collection. And while it sounds, boring and backwater and bureaucratic, it has a tremendous impact on everything the federal government does. Probably a lot of you have seen in recent weeks a controversy bubbling through the media having to do with whether the U.S. Census Bureau will ask certain questions on the 2020 census. Well, all of that discussion centers on the Paperwork Reduction Act and the authority of a unit within the Office of Management and Budget called OIRA, the Office of Information and Regulatory Affairs. Well, OIRA is the one that approves the Standard Form 424 series, which is the application for federal assistance. And the components that you see there on slide number 7 have been blessed over and over again throughout the years. Perhaps the thing that's most important related to all that is the certification that you sign when you make a federal grant application. What it says in pertinent part is that the information in the application is true, complete, and correct, and that your organization will comply with the federal rules if the assistance is accepted. It then cites a statute from Title 18 of the United States Code. That statute is called the False Claims Act. Makes it a federal criminal offense to make a false statement to the United States government. You might want to ask General Michael Flynn about the False Claims Act whenever you see him. Anyway, my point is that this is where the beginning of the legal knot between the federal government and the recipient begins to be tied. Slide number 8 addresses pre-award agency review, and this is a place where things have really been ramped up. Federal agencies have been told by OMB to conduct a merit-based selection for discretionary awards. And discretionary awards, of course, are those where the federal agency is deciding who's going to get the money and how much they're going to get, as distinct from formula grants, which are obviously awarded based upon underlying data elements and things of that nature. Well, OMB on 2 levels has focused on due diligence on the part of awarding agencies. 2 CFR 200-205 instructs federal agencies on how to conduct pre-award risk assessment, and the criteria that are listed there on slide number 8 are the things they are supposed to take into account. But further, pass-through entities, primary recipients who are making sub-grants, are also expected to make risk assessments of their potential sub-recipients. Now, this is not a one-size-fits-all arrangement. How deep the risk assessment goes depends upon the circumstances. I would suspect that some of you who have significant history in federal grant activity would probably not experience a deep dive into some of the areas that are talked about here. On the other hand, an organization that is new to a federal agency, hasn't been funded by them before or hasn't been funded by them in a long time, is probably going to get a finer tooth comb examination as a result. And notice one of the bullets there under criteria, audit history. Past audit findings are going to have a way of coming back to bite somebody. It may not mean that you don't get funded, but it's entirely possible that if you've got open audit findings, correcting those will be made part of the terms and conditions of your follow-on award. So, you know, good management is good grantsmanship. Slide number 9 addresses the result of the pre-award review, the pre-award agreement. And once again, OMB likes standardization. So in section 200-210, they've identified the components that need to go into a standard federal grant award. Now, the fact that those components are identified doesn't mean that every federal agency is going to make their grant agreement look the same. You're going to find some variation in terms of the format and presentation. But what you will also find is if you scrape the surface of that, you'll find the specifics identified according to the components that OMB has identified. And that same sort of philosophy has been brought down to the next level. Pass-through entities under section 200-331A are told what they're supposed to put into their sub-award agreements. And this is one of the places where the whole discussion of indirect cost recognition surfaced in a very prominent way. Pass-through entities have been told that they have to fully recognize any negotiated indirect cost rate agreements that have been made by the federal government. In other words, they've got to pay sub-recipients indirect costs. If the sub-recipient doesn't have a negotiated indirect cost rate agreement with the federal government, then 2 options exist. One is that the sub-recipient negotiates a rate with the pass-through entity. The other is where the sub-recipient elects to take an indirect cost rate known as the de minimis rate, which is 10% of their modified total direct costs. Now, I hasten to add here, pass-through entities cannot force a sub-recipient to take the de minimis rate. So this is a place where there's been a certain amount of friction because a lot of pass-through entities don't want to get into the business of negotiating indirect cost rates because they think it's a lot of work. I would beg to differ with them if they really understood what's going on, but that's a whole other discussion. So the point is, this is a place where, particularly those of you who become sub-recipients in certain programs and projects, need to be aware of your rights. And section 200-331A-4 is where that shows up. Now, let's assume that everything went well in the pre-award stage and you've gotten your federal award. What are the things that are going to happen after that? Well, the first is that you're in a position to incur cost, that the approved budget gives you the authority to expend funds by incurring obligations. You're going to order supplies, you're going to order equipment, You're going to hire personnel. And so by doing all those things, you create an obligation to pay for those things. And so the cost principles, subpart E of 2 CFR 200, are the tools that you are supposed to use for deciding whether to charge something to your federal award. Now, the thing I want to emphasize here is that your approved budget is not necessarily the only things you can spend money on. As I pointed out a little while ago, there are 8 object class categories of expense in the standard Form 424 budget. Okay? There are 55 items of cost identified in the cost principles. So there are going to be things that come up during the life of the project where you didn't anticipate that expense. And then the $64,000 question comes in, can we charge this to our federal award? And the answer is, it depends. It depends on what the cost principles say and how you interpret those cost principles. So the general tests of allowability, where it talks about the cost being necessary and reasonable and allocable and consistently treated, all of those criteria are things where there can be differences of opinion based on perception. But one of the underlying features of those general tests is you are supposed to incur the cost using sound business practices. And so that crosswalks over to the management systems requirements that we're going to talk about in a few minutes. Now, as far as these selected items of cost are concerned, the 55 items that I mentioned, why were those selected? Well, there's probably 3 answers there. One of them is that the cost is a type that OMB believes most organizations involved in federal grants are going to encounter in the course of doing business with their federal agency. A second reason is they don't want you charging it to them. There are a few costs that are expressly prohibited. We got along for a lot of years without ever mentioning alcoholic beverages in the cost principles. Well, it's there because a recipient asserted that it was employee health, morale, and welfare expense, and they won that case. OMB said, we'll fix that, and introduced a prohibition against that, which, of course, most grantees would never have even dreamed, going near that. That's my point. There are a number of things like that that are really defined in because of some bad behavior by a limited number of recipients in the past. And finally, there are a couple of cost principles that are in there because the recipient community specifically asked for an interpretation of that, and OMB obliged them. Final thing I want to mention relative to the cost principles is an introductory phrase that appears at the beginning of subpart E. It's actually in 2 CFR 200.420. It says, failure to mention a particular item of cost in the principles does not mean it is allowable or unallowable. Rather, allowability in each case will be based upon the treatment of similar or related items of cost. That's when the interpretation of these arrangements comes into play. So if there's something like it on the list, or you can make an argument related to the allowability, then that particular phrase opens the door to making the claim. But I think it's fair to say as well that many organizations are very nervous about being aggressive in interpreting the cost principles because they want to avoid any disagreements with their funding agency. So the more interpretive you are, the more you're likely to find somebody who might disagree with you. That somebody might be an auditor, it might be a project monitor, it might be an awarding agency official who signs your agreement. So, being a strong user of the cost principles, I think, is an empowered position for recipients. Slide number 11 focuses on cash management. One of the nicest ways the federal government can assist you is to let you draw down funds in advance. And advance payment is a hallmark of the requirements. Now, one of the things that OMB has done in Section 200-305 is to emphasize a policy that's actually been in effect for many years, but has often been ignored. Recipients can very easily draw down against a letter of credit that's been established for them by the federal government. But often pass-through entities, primary recipients, have put their sub-recipients on reimbursement. In other words, making them incur cost, disperse their own money, and then request payment. That is clearly not acceptable under Section 305B of these regulations. And I know for a fact that this is causing a certain amount of friction between some pass-through entities and their recipients, primarily because the pass-through entity has been doing it wrong for so long, everybody assumed that was the way it was supposed to be. Now, assuming that advances are being made, the timing of the drawdown of funds is supposed to be as close as administratively possible to the time that the disbursement will be actually made. The amount of the drawdown should be related to what are immediate cash needs. So if somebody needs to meet payroll or make disbursements to contractors, then those should be what drives the amounts that are being requested. When cash is drawn down, it's supposed to be put in a cash depository, so it's safeguarded. And OMB says that it should be put in insured accounts whenever possible. Now, this is where I run into some problems for some of my clients who are operating overseas, because the cash depositories they can work with are not federally deposit insured accounts, whereas here in the States, it's pretty easy to get a secured account. So that's part of the reason why the language in the cash management requirements is a little shaky. Further, any interest you earn on the federal funds advanced belongs to the federal government, and so it must be captured and refunded in accordance with these requirements. That's one of the reasons why a lot of larger recipient organizations decide that they're not going to seek advance payment because they don't want to have to keep up with any interest. They'll make their own disbursement, contemporaneously draw down the funds, and so they're always in a negative cash position with the government. I'm not sure that that's going to be practical for some of your organizations, but it shows a behavior pattern that is out there in fairly prominent fashion. Now, in post-award, you're required to document the transactions, and let me flash up an audit alert right here. I do a lot of audit resolutions as part of my practice. Audit resolution being an attempt to try to get audit findings set aside so that disallowance of cost won't occur. That's when grants management becomes a contact sport. Well, auditors love to say if it's not documented, it didn't happen. Well, not necessarily, but there are several places within the uniform guidance, and this is stuff that's been ratcheted up again with the new requirements, where there are specific documentation requirements you need to be aware of. One of them is in effort reporting, time and effort reporting timesheets. Okay, that's still out there, particularly identifying the fact that any effort reporting has to be after the fact, what actually was done, not what was budgeted for, and requires full disclosure of all time worked, so we can figure out what bucket of revenue to get somebody's salary out of, or what buckets is more appropriate. Another audit alert relates to travel justification. There's a new requirement that says that when somebody travels on a federal grant, the organization needs to justify an internal document that says why that person needs to travel and establishes that the expenses they're going to incur are consistent with the organization's travel policy. You can bet that the auditors are going to be looking for that going forward. Procurement transaction history is another one. I'll save the details of that for later, but suffice it to say at this point that what you're expected to do is be able to show from the time the decision was made to make the purchase to the time that the goods or services were delivered and paid for, that it shows an audit trail of what was done. And finally, property management standards, particularly related to management of equipment. Section 313D contains 5 elements that each organization must have in place related to their management of equipment. Another audit alert, if you will. Auditors love this stuff. You know, they go in and look at your property records and say you're missing serial numbers, or current location is missing, or something of that sort, and they can prove they were there. So don't overlook the mundane property management standards. Slide 13 focuses on reporting. And I guess the way I would characterize the list on slide 13 is, here's a checklist for you. These are all the things within the uniform guidance that you're being told you have to report on. Now, the financial reporting, of course, the standard form 425 is what's used between a prime grantee and the federal government and is authorized under the Paperwork Act. Performance reporting, on the other hand, is not as standardized because routine performance reporting is essentially drafting of a narrative statement that says, here was what was expected of us during the reporting period, here's what we accomplished, here's what we encountered in terms of problems or slippage, and here's how we took care of that. So, you know, your wordsmithing is part of what's going to be done there. But don't forget as well that there's a provision in Section 328 that says you are to immediately report to the awarding agency any development which could materially affect your ability to perform the award. Now that's a fairly high bar, but it also means that if something's really going in the ditch, informing the awarding agency of it as soon as it becomes clear is critical. And my experience is a lot of organizations, you know, are in denial about things like that and wait for things to get so bad that when it finally all comes out, the stuff hits the fan. There's a mention in this list as well of a reporting requirement that is not in the uniform guidance. That's what is referred to as the Fafada reporting. Fafada stands for Federal Funding, Accountability, and Transparency Act. And the regulations on that are also entitled to, but in Part 170. This is where organizations are expected to provide information to the government so that a particular searchable website, usareporting.gov, can be accomplished. And primary recipients or pass-through entities have an affirmative responsibility related to their sub-recipients on this particular subject. So, you know, keep that one in mind if you're in the sub-grant business. Now, the final step in the process is after the award, and the rules address a couple things about that. First, closeout. Closeout is a routine administrative action taken by the awarding agency in response to the submission of final reports, the settlement of any cash and claims, and the disposition of property. Now, that might seem to be, again, kind of a backwater discussion, but this has taken on a life of its own in recent months, in part because the Government Accountability Office, the GAO, did a study at the behest of Congress and found that there were substantial backlogs in federal agencies about closed-out awards. Well, what makes Congress upset about that? The fact that those unclosed awards contain obligated funds, which could be, if they were deobligated, coming back into the Treasury. So that got Congress very excited about this, and there's a lot of pressure within the entire federal grant community, all across the board, federal agencies, to expedite closeout. And not surprisingly, some federal agencies are blaming their recipients for the slow closeout. So things are kind of flowing downhill on this whole subject. If you get to the end of a performance period, this is something to get disciplined about. Make sure you're doing it in a timely fashion so that the finger can't be pointed at you. The other thing to remember about after the award is there are some things that live on after the award is over. Those things are identified at the bottom of slide 14. Record retention and access. You keep the records for at least 3 years after the submission of the final financial report. custody of retained property. So in many cases, you're going to get to keep the stuff you bought. And finally, awarding agency audit rights. As long as you've got the records, they can come in and look at them. So even though OMB doesn't specifically say this, there's a pretty strong hint in Section 200-344 that when you get to the end of the record retention period, it's time to look to Iron Mountain or Oliver North or some other recycler to get rid of the records, because otherwise there's a potential vulnerability there. Now, moving on to slide 15, let's focus on some of the system standards. What are the kinds of policies and procedures you've got to have under this set of uniform guidance? This is a place where there are some unique additional requirements that have been introduced, but the basic approach that's been present for many years is still largely blessed. So, on the system standards related to financial management, the design and operation of your financial management system is left up to the organization. The federal government doesn't dictate how your accounting system is structured, things of that nature. What they say is you've got to be capable of doing the things that are contained in these standards. You've got to have accounting records. You've got to be able to do fund accounting, which is grant by grant determinations. Let me skip over internal controls for a second. You've got to maintain budgetary controls so that you can compare actual expenses to budgeted amounts and determine whether budget modifications are needed. You've got to get reports in on time, current, complete, and accurate. And arguably, this is the one giveaway that an awarding agency will use to figure out whether there are problems. I saw a report not too long ago from a federal inspector general's office that said that 18% of the financial and performance reports from grantees in that agency were late. Well, who do you think that agency was spending their time on? The 18% who are out there straying around. The 82% that were in place are in the herd and probably not being attended to. So be in the herd. Cash management and cost allowability determination. In both of these cases, OMB specifically says you've got to have written policies on those subjects. Now, the written cash management policies are going to tie back to what I said earlier about payment. The written cost allowability policies are going to be a description of how within your organization determination of allowability is made. So this gets down into personnel assignments, if you will. At what level within the organization is somebody authorized to spend and to make the determination that will be charged to the award? And under what circumstances is a decision like that going to be elevated to the finance director or the executive director or even to the board of directors of the organization because that determination is something that's not mentioned in the cost principles or is potentially disagreeable. Finally, source documentation. The underlying books and records that show that the charges that are made are for allowable eligible cost. Now, with the exception of the examples I gave a moment ago related to time and effort reports, procurement records, travel justification, and so on, the determination of what your source documentation needs to look like is primarily your own organization's. In other words, what makes things a federal case is when you don't have documentation that is consistent with your own policies. And so a federal auditor or an independent auditor comes in and you don't have the kind of backup that your own policies say you're supposed to. That absence of documentation is what turns it into a federal issue. Now, slide 16 gets to the procurement discussion. And again, we're going to do a deep dive on that in a week. But this is not a particularly well-crafted section. Sections 317 to 326 OMB jumps all around in that document. And so what I've listed here, hopefully, is in a more logical sequence of what's going to be discussed related to how you engage in buying goods and services using federal funds. A couple of key things that I want to mention right now. Code of conduct. The feds are extremely interested in how procurement ethics are carried out within your organization. And it's, how people who are making purchasing decisions are going to behave during that process. And this goes from the top of the organization to the bottom and back up again. So, this is a place where, anybody who touches a purchase decision has got to be subject to those rules. Another aspect of this is the acceptable methods of procurement. This is one of the places where, because of all the angst that surrounded the way OMB presented this, certain groups of grantees, primarily from the universities, went to Congress and asked for congressional relief on some subjects. And one of the things that Congress did, I'm sure they didn't realize they were doing it because they did it in a very large piece of omnibus legislation, is that they addressed the dollar thresholds that organizations can use for what's known as a micro purchase or the simplified acquisition threshold. Now, we'll get into both of those in detail next week, but suffice it to say that this shows the relationship between statutory law and the super circular. Anything that's in statute takes precedence over a regulation, despite the fact that it was promulgated through formal rulemaking. Slide 17 addresses property management, and there are 4 kinds of property that are the subject of these requirements. Real property, which is just like we think of it in normal commercial transactions, equipment, supplies, and intangible property. Now, the big news here is that the definition the federal government has for equipment has not changed. It is something that has a useful life of more than 1 year and a unit acquisition cost exceeding $5,000. That's been the case since before the turn of the century. But what OMB did do, and they did it in the cost principles, was they established that computing devices, things like laptops, tablets, smartphones, and so on, are considered to be supply items, even though we might refer to them as equipment. Because they don't meet the definition of established in the rules, they're treated as supplies. And so prior approval to buy them is not required. Things of that nature make it a lot simpler. This is a place where significant burden has been reduced. Now, the administrative issues that come up in the property management arena have to do with who owns the property. Title vests with whoever bought it. So if you're the prime recipient and you buy it, you own it. The federal government may have a residual financial interest in it, but nonetheless, title vests with you. If a sub-recipient buys it, then they own it, and the primary recipient may have a residual financial interest in it as well. OMB has clarified that the use of the property is for the original purpose under the program that helped buy it, but that there's no requirement that it be locked up and not used on anything else. The major control related to equipment is whether to let you buy it at all. Once it's there, the assumption is that your governmental or tax-exempt purpose is going to allow you to use it for purposes that benefit the general public, and that's pretty ancillary. Now, the other thing I want to mention that again is OMB hanging a light on a long-standing policy has to do with management and disposition of equipment. If you buy a piece of equipment, it's got a useful life of more than 1 year and a unit acquisition cost exceeding $5,000. You use it for a while, and then the end of the project comes. If that equipment is worth less than $5,000 fair market value on a unit basis at the end of the project or program, you can keep the equipment, sell it, dispose of it however you choose without compensation to the government. Section 203.13D explicitly talks about this. So keep that one in mind. Now, moving on to slide 18, let's talk about sub-recipient management and monitoring. And this is where OMB really ramped things up as well. The first thing they did was to try to make it clear how organizations that are pass-through entities determine whether transactions they're entering into with somebody at a lower tier constitute a sub-recipient relationship versus a contractor relationship. One of the good things that OMB did here was they got rid of the word vendor. Some of you may remember that under previous policies, particularly OMB Circular A133, the term vendor was introduced and it caused a lot of confusion. So OMB ratcheted back and calls parties from whom a recipient buys something as contractors. But there's a lot of careless use of terminology here. And so the chart that you see on slide number 19 is something that I would urge you to use in talking about this particular subject. Essentially, in the environment in which you're operating, the federal government agency, whether it's the Northern Border Regional Commission or some other federal agency, is up there at the top. We've determined that what they're engaged in is federal assistance, where the purpose of the action is to assist, stimulate, or support a non-federal party. That next level organization is called a grantee or recipient. And as you can see as well with that burst on the side, that is an organization that may be a pass-through entity. Well, what the government is saying is that recipient, that pass-through entity, has got to decide, based upon the criteria contained in this regulation, whether the relationship they're entering into is one of a sub-recipient relationship or a contractor relationship. The most fundamental things you got to remember about this, it has to do with the fact that if you determine somebody is one or the other, there's a different set of rules that applies to that relationship. For example, the procurement rules we're going to talk about next week apply to how you select a contractor. They don't apply to how you select a subrecipient. On the other hand, when you engage a subrecipient, the federal funds you are providing them do not lose their identity. Whereas when you pay a contractor for value received, that's the end of the audit trail. Well, not surprisingly, the federal government's gotten very excited about all this because some of the inspectors general think that recipients, pass-through entities, are manipulating the relationships they have in order to create contractor relationships rather than subrecipient ones. So, the criteria contained in section 203.30 are the factors that need to be influencing that decision making. Slide 20 gets to what you do vis-a-vis subrecipients. And when I say what you do, I'm assuming that a lot of you are in the business of getting money from the awarding agency and turning around and sub-awarding it. But, if an opposite situation arises and you're a subrecipient, then this is what you should expect is going to be done vis-a-vis your relationship. Well, as I talked about earlier in the presentation, one of the things that's supposed to happen is that the pass-through entity conducts a risk assessment about the organization with whom they're doing business to find out who they are, what kind of reputation and capability they have before entering into the relationship, and then to form the sub-award agreement based upon that arrangement. Well, the sub-award agreement then becomes the governing arrangement vis-a-vis the subrecipient. Both parties are supposed to adhere to it. But here's where OMB hangs a big light on oversight by pass-through entities. They say that in sections 331D through F, that the pass-through entity will monitor sub-recipients as necessary and establishes certain baseline mandatory steps. Once again, my flashing sign audit alert should be prominently featured here. If you're a pass-through entity, you better monitor all of your sub-recipients at least to the level of what the mandatory steps are. And then OMB lays out some of the things that can be done, things that are discretionary. Well, if you're in that position as well, recognize that discretionary steps aren't necessarily required, but if an organization establishes a policy that they're going to use some of those discretionary steps, they need to be able to make sure that they're doing it. I'm thinking, for example, one of the discretionary steps is doing site visits. There's no requirement anywhere in the uniform guidance that site visits be made. But if an organization says, well, we're going to make a site visit of every one of our sub-recipients once a year, then here comes the independent auditor saying, well, how many sub-recipients have you got? 12. How many site visits you make? 9. And you've got an audit finding on your hands. So be careful that when you're exercising discretion, that you've got the ability to carry out what it is you say you're going to do. And again, think about this from the other side. If you're the sub-recipient and organizations are exercising discretionary steps on you, one of the main complaints I hear from sub-recipients all the time is the idea that a lot of prime recipients are coming to visit them asking the same questions that somebody asked 2 weeks ago. And unfortunately, sometimes those questions are being asked by state agency A after state agency B was there, a couple weeks ago. This is also placed within the rules where OMB allows federal agencies to approve limited use of fixed amount subawards. So this is encouraging the possibility that a pass-through entity would decide that instead of making a cost reimbursable subaward, they would make a fixed amount subaward and focus instead on the accomplishment of project objectives rather than whether the costs that were incurred in doing so met the allowable cost criteria. Now, just a few other things before we go over to questions and comments. Slide 21 focuses on cost allowability of the grant budget. The 8 object class categories of expenditure that are direct costs are listed down the left-hand side of the chart there. There are 9 bullets because indirect cost is an additional one. But as I've said a couple times, there are 55 selected items of cost identified in Subpart E. There's really no substitute in dealing with this section to get fully caffeinated and sit down and read through Subpart E, and then keep it close at hand going forward. Because usually the answer to the question, is this cost allowable? The proper response is, it depends. It depends upon the facts and circumstances. It depends upon the text that's contained. Let me give you an example. One of the costs that's identified in the 55 items is lobbying. And there are a lot of people who, in a knee-jerk reaction, will simply say lobbying is unallowable. Well, if it was unallowable, OMB could have said that in a single sentence. Instead, the discussion of lobbying is a page of federal regulations long, because there are certain kinds of government relations activities that are allowable costs. There are a bunch of others that aren't. And so what a lot of organizations do is they, rather than differentiate allowable from unallowable, they just walk away from the entire area and say, we're not going to charge any of that to the government. And is the government worried about that kind of decision? Of course not. Okay, so it really does bear some study here in terms of what those requirements are. And if it's not a question of study on an initial basis, it certainly should be when it's time to incur the cost. I can't tell you the number of times I've been involved in disputes where if somebody had just gone back and read the the text of the cost allowability determination, that dispute would never have arisen. Now, on slide number 22, I've listed out those key cost principle changes, the sections of the uniform guidance that have been tweaked in some significant way. I've talked a little bit about effort reporting already. Conferences, I better mention that one. The conference cost principle is a direct line back to a very egregious conference that was conducted by the U.S. General Services Administration in, of all places, Las Vegas, Nevada. When that particular conference and all the details associated with it hit the press, the rest was history. And so OMB not only curtailed what federal agencies can do in the conference area, but they also tightened up the requirements related to what recipients can do when they are either attending a conference sponsored by somebody else or they are sponsoring the conference themselves. Now, dropping down to equipment and materials and supplies, section 200-453 is the place I want you to hone in on related to my discussion about computing devices, because that's a place where, virtually every recipient in some way or other is going to be affected. Proposal costs. I mentioned this one as well. OMB did a real favor for organizations in your position because they established that the allowability of proposals relates to successful and unsuccessful proposals. In other words, the cost of submitting proposals, whether for grants, contracts, whatever, is a cost of doing business. And the fact that you didn't get the award doesn't mean that you can't charge it. What the government does say, however, is that generally this kind of cost will be treated indirectly. Okay? Something else that's probably relevant to today, the cost of training. OMB replaced a full page of regulation with a single sentence that says training and education for staff development is allowable. And hopefully it's valuable to you as well. Slide 23, indirect cost recovery. Here's where OMB ratcheted up attention as well. Federal agencies are required to recognize federally negotiated indirect cost rates. If you have a cognizant agency for indirect cost and they give you a rate, and then you go and apply for a grant from some other federal agency, that second federal agency is obligated to fully recognize your costs. Now, one of the problems that exists for a lot of regional organizations, and I've worked with NADO on this, is that the requirements in the rules do not require you to submit an indirect cost plan unless you receive more than $35 million annually in federal awards. Well, I'm sure we've got very few, if any, organizations on this call who are in that boat. Well, what that means is it's difficult to get a federally negotiated rate. And so that's a place where organizations are told in the rules to develop their indirect cost proposal and hold that proposal and in their records, use the rate that results from it, and have their independent auditor verify the accuracy of their rate during the single audit process. Now, as I said earlier, there's a whole other iteration related to how pass-through entities are supposed to handle this. They too are being told they have to recognize federally negotiated rates. If there's not a federally negotiated rate, then they have either to negotiate a rate with their subrecipients or let the subrecipient at the subrecipient's behest use the so-called de minimis indirect cost rate, which is 10% of the modified total direct costs that organization is accepting or is incurring. Now, the last major area of policy that the uniform guidance addresses is the single audit requirement. I mean, there are some people who think the reason we have grants is so we can do audits, but this particular section built on the previous OMB circular A133, and A133 was superseded effective December 26, 2014. For fiscal years that began after that date, the threshold that triggers the need to do a single audit is $750,000 of expenditures from all federal sources, either direct grants or sub-grants. Okay? Now, what that resulted in was elimination of some 5,000 organizations nationwide from the group that has to do single audits. But OMB was really interested in bumping this even higher because of their assessment of cost and benefit. Now, the scope of the audit is still the same. The auditor is supposed to determine whether your financial statements and your schedule of expenditures of federal awards are accurate in all material respects. They're supposed to study and evaluate your internal controls, your policies and procedures for managing federal funds, and determine whether they are well designed and they're being followed. And finally, they are to assess compliance with laws and regulations that could have a direct and material effect on federal claims. In other words, laws and regulations that if you violate them, you're going to be paying money back. Now, the best way I can think of to be ready for the audit is to use something called the OMB Compliance Supplement for Single Audits. It is an audit guide which tells you which areas the auditors are going to test and suggests ways that they do the testing. So it's really a window into what's going to go on in the audit process. I like to refer to the compliance supplement as the Cliff's Notes of grants administration. And some of you remember Cliff's Notes fondly because that's how you got through college. The audit results that come out of the audit are also critical because, as you saw earlier on, there was a discussion about the fact that audit history of an organization can be used as a basis for decision-making about follow-on federal programs. So making sure that audit findings that come forward in an audit report are, first off, fully developed, so that if you're being accused of noncompliance or deficiencies of internal control, the auditor is giving you sufficient information to verify whether they're correct or whether some pushback is warranted. That audit reporting package that is forthcoming out of this is going to be a tool for both your own organization and for the funding agency. Another thing to keep in mind is the requirement for submission. You've got 9 months after the end of your fiscal year to get your audit reports into the Federal Audit Clearinghouse. If you don't get it in on time, under the new rules, you are automatically precluded from being treated as what's called a low-risk auditee, which is an organization that is subject to less compliance testing. So just by being late, you take yourself out of that. That's a new requirement. And finally, audit resolution. The federal government itself has imposed on it a requirement for timely management decisions. Pass-through entities have the same thing. So if you're a pass-through entity and you've got sub-recipients who've got audit findings related to your funds, you've got 6 months from the time that finding comes to your attention to issue a decision about what's going to be done about it, whether you're going to disallow cost or compel corrective action or things of that nature. There's another audit alert. Now, I've droned on for quite a while, but let me wrap up with just a few takeaways. Slide 25. Keep OMB's intentions in mind. OMB wanted federal agencies and pass-through entities to do things uniformly. If you see somebody doing something out of the ordinary, where's the authority for that? Burden reduction. Look for opportunities for that to be eliminated. And remember that OMB stands for management and budget. So there are numerous aspects of cost containment that are also presented here. Keep the primary source documents handy and consult them. I mentioned there's no substitute for going back and rereading sections to see what really is required. Yes, there are some parts of the language that aren't particularly well presented. I have a feeling that some of them were left ambiguous on purpose, but by and large, there's an answer somewhere in that 2 CFR 200. What does your agreement say? Make sure that it aligns with what is required under the new rules. A lot of organizations, whether they're federal or non-federal, who are making federal grant or sub-grant awards, are using old templates. And it wouldn't or shouldn't surprise you that some of the things that should have been taken out because they're no longer applicable continue to find their way into agreements. I see this all the time with organizations that get an agreement and the agreement is internally inconsistent because in one section it says do this and 3 pages later it says do something else. Well, some part of that's wrong, and the best way to clean that up is to do it at the time the agreement is presented. Don't be so excited to sign anything before you make sure that it really does represent a sound and complete agreement. Conduct some reviews of the areas that I've identified here on the chart. The way you do grant application budgeting should align with the cost principles. Your existing internal controls, what kinds of procedures do you have and how are you operate them? We'll talk more about procurement next week, but we've gotten into sub-granting. Certainly, because of all the things OMB has done in that area, a lot of organizations are having to re-examine their relationship with their sub-recipients. The bottom line is the federal government expects you, if you're a pass-through entity, to act toward the sub-recipient the same way they, the feds, would act toward you. And document that you've done those reviews and any changes you make. Not that this is just a paperwork exercise, but make sure that people who are looking over your shoulder understand that you've taken this seriously. Recognize that everybody's in on a learning curve. There are a lot of awarding agency personnel, a lot of auditors who are catching up with these requirements as they go, maybe thinking that they're staying one step ahead of grantees and recipients. And finally, circle your organizational wagons. The responsibility for these rules rests firmly on both programmatic personnel and financial and administrative people. Too often I see organizations where there's conflict between those folks, and there really needs to be team building. So hopefully you can, by recognizing that your organization is vulnerable if these rules aren't followed, everybody's got an interest in doing it right. Well, let me turn it back over to Laurie and Chris, and we'll open it up for your questions and comments.
Well, thank you very much, Bob. I've sat through a couple of your webinars on these guidelines, and I always learn something each time, so I appreciate the time. I have to say that you must have been super thorough because I have no questions in the question box. So unless...
Well, I think there's one, though. I'm not sure if it's posed as a question.
It's more of a comment, just that FGCA should have included reasonable time for grant notices. Basically, they feel that notices are publicly distributed 2 weeks before a deadline, which is not enough time, which I think is something we all struggle with, but that was more of a comment.
And that's a valid comment, and I will say that one of the things that happened during the comment period when OMB was trying to address that issue was they initially in their proposal said that every federal agency would be required to give at least 30 days notice, and individual federal agencies, and I'm not sure which ones, pushed back on that, essentially alleging that part of the problem was that they couldn't do that because of what was happening on Capitol Hill vis-a-vis appropriations and things of that nature, and OMB apparently caved on that issue. In the federal acquisition regulation, which applies to federal contracts, there is a regulatory provision that requires that if a federal agency is going to award a contract except under emergency circumstances, and the emergency is clearly identified in the reg as to what constitutes an emergency, so that poor planning is not an emergency. But the bottom line is that the feds have to be much more rigorous with themselves on the contract side of the world than they do in the grant side. And it's unfortunate that that wasn't something that OMB was in a position to make stick.
Well, I just want to say thank you, Bob, for your time, and I hope that everybody that's been on the webinar, lets other people know in their office or whatever else that they can join us next week as well.
Well, it says on the front sheet a quick gallop, and I understand that going fast through a lot of this stuff, some folks' eyes may glaze over. But part of why I wanted to make sure we had plenty of citations in here is so that, you've got a roadmap to go back and find the answers yourselves and empower yourself to use these rules to your best advantage. I mean, this is not a case of, trying to fool the federal agency or anything of that sort. I mean, my experience is that federal agency folks welcome the fact that the grantees that they're dealing with know the rules themselves, know what the parameters are, and know how far everybody can go in making management of these funds effective. I mean, that's really where everybody's trying to head.
Great. Well, again, thank you so much, Bob, and thank you, everybody, for participating. And we will reconvene in a week for the webinar on procurement. So at this point, we'll end this webinar. Thank you very much.
Thank you. Bye.
Are we back in a subsection or everybody off? Hello?